Hello everyone and welcome to a stocks analysis video. Now I just want to post a disclaimer. This is you could lose all your money from investing, so if you follow my trick and you lose all of your money, then that's your fault and not my fault, and I am not going to be taking any of the blame for it. However, if you're here to learn something, then that's perfect, because that's exactly what I'm here to teach. Hopefully you'll learn something here. So I've already done everything for Cisco. Let's just get right into it. So we come over here and we see a high and we see a low. The high means that the highest price of the stock during the year, and low means the lowest price of the stock during the year. So for 2015, we have this information, 2014, we have this, 2013, and so on and so forth. Next, we have EPS, which stands for earnings per share, but just say EPS because who really gives a crap what it stands for? So, EPS, this is also given information that you can get from like NASDAQ.com or when the company files the annual report for 2015, 2014, 2013, and 2012. Now this, to get the PE ratio, all you have to do is divide the price of the stock divided by the EPS. So to get this 17, all I did was do the 3019 divided by the 178, and to get the PE low price, all I did was 2462 divided by 165. And then for this year, I did the same thing, except I used these numbers over here. In 2013, I used these numbers. In 2012, I used these numbers. Now, current is just where the market closed at. So the last day the market closed was December 31st, 2015, and that's the last time the market was opened. It closed at $27.16. Excuse me. So then you come over here and we have average high and average low. Average high just shows that the average PE for over the last 4 years, and the average low is the average PE over the last 4 years. Now we come over here, and this EPS 2016 is based on estimates of what analysts recommend or analysts expect the company to deliver. Now these are, big investment banks like JP Morgan, Zacks, Goldman Sachs, Merrill Lynch, Vert, I think that's one of them, Vert, a whole bunch of analysts and investment banks whose jobs are to follow these companies and see where the stock is going. So now that that's all done, this right here that's highlighted is an assumption. Oh, by the way, this L means low, this H means high, and this A means average. So the low is the lowest what analysts expect the EPS to be in 2016. The high is the highest. The highest analyst expects it to be here, and the average of usually 15 to 20 analysts expect it to be about this range, so $2.10 in this case. Now this over here is where the formula comes into place, and this is just doing the EPS times the PE ratio, and that's where you get this part. And then the average target means that according to this formula, this is where you would expect it to be between 25 and 33. The average of that is 29. Between 26 and 34, the average of that is 30. And between about 26 and 34 again, the average is about 30. So if you want to see like a percentage and whatnot, all you have to do is equals the price that you purchase it at, which is going to be the price that you sell it at, which worst case scenario would be 25 approximately over here, and what you purchase it at, which is about 27, and you divide that by what you purchased it at. And the 25 I got from right here. The lowest it looks like for 2016 according to this information and this formula will be $25.20. I'm just using whole numbers because that's very easy for people to understand. So if the price in 2016 of the stock goes down, if Cisco has a really bad year, we'll expect about a negative 7% gain or a 7% loss. So if we expect Cisco to have a great year, we will do equals parentheses 35 minus 27, which is what we purchased it at, divided by 27, which is what we purchased it at, which is about 30% gain. And then if you want to get the net gain, all you do is this plus this, which means that you have about a 22% net gain, but Cisco also pays dividends, which is about 3%. So it would be 23 plus 3, so about a 25% net gain is what you're expecting from Cisco. But, that's assuming that this pans out. All this, everything on the screen currently pans out the way that it should pan out. So this is obviously an assumption, and it could go completely haywires, and the stock can drop down to like 21 if it wanted to. So keep that in mind with all this while you're absorbing all this information in, and just remember that this is a guess, an educated guess, so it could still be wrong, but it could also be right. Now, what this means is that if you factor in the dividends, if you put in $100 in today and you sell it in about 1 year from now, and by about 1 year I mean somewhere around Thanksgiving, Christmas, New Year's time, around that time period, you would expect your $100 to turn into $125, and that's assuming that this pans out the way it does. Remember, that's an assumption. So assuming that Cisco has a great year and we have a net gain of 22% plus 3% dividend, your $100 would turn into $125 at the end of the year. Okay, now let's go to a different one, which I have highlighted as yellow, which is Coca-Cola. So we'll do the same thing over here. We'll do equals, which if Coca-Cola has a bad year, if we come look at it, it looks like about 38, and we minus it at about 43, which is what we're going to purchase it at. Make sure you put it in brackets, and then you divide it by the amount that you purchase it at. Now, if Coca-Cola has a great year, we would expect it to be about 50, so we'll do 50 minus 43, and again, this is assuming that this information is correct. Of course, it could be wrong, so just keep that in mind. Divided by 43, which is a minus 11% gain and a plus 16% gain, which if you add it up, you have a net gain of about 5%. However, Coca-Cola does pay a dividend, which is at about 3% dividend annually. Remember, this is annually. So you would have about 5% plus 3%. So if this is to be assumed, if Coca-Cola stock pans out the way that this picture right here is showing, you would expect about an 8% gain for 2016. This is assuming that all the information on the screen right now pans out the way it does. Now, let's go and do one together. Well, really, I'm just doing it on my own and you're watching. So, we use Yahoo Finance, we use Starbucks, and we use NASDAQ, okay? So first of all, we'll use NASDAQ. Over here is what analysts expect, 2016 to pan out for Starbucks. You see it says September 2016. That's because we're going on physical year and not on calendar year. So keep that in mind. That means that Starbucks annual thing ends in September. Physical year, okay? Now we'll go to this one and we'll type in the EPS, which we have EPS at 182 for 2015, 135 for 2014, and 0.01 for 2013. And then we go to the next page and we have 0.89.5. There we go. Now we go to the boring part. This really is the boring part. So we have a high in 2015 was about 63.5, 63.51, and the lowest price for the year was 39.79. Now we do the same thing except for 2014. We go over here and it looks like the high for 2014 was about 41.90 and the low looks like was right around here, which was at 34.37. Then we go to 2013 and do the exact same thing, and it looks like the high was right around here at 40.99, with the low being all the way down here at 2660. And then we go to 2012 and we do the exact same thing. We have a high of about 40.99. I did not put 2012. Excuse me while I change that really quickly. Whoops. The high was at 30.83, and the low looks like was right over here at 21.58. Now we're done with the internet, so we come back over here. So first thing you have to look at is there's an outlier in the PE ratios, the PE averages. You see an outlier of this 4,099 and 2,660. I already took account for that and took it out, and instead of dividing by 4, I divided by 3 because I only included 2012, 2014, and 2015. So this, and this. Got it? So according to this information right here, it looks like Starbucks is not going to have a good year of 2016, but that's according to this information. So if we just follow the things that we've been doing, if Starbucks has an awful year, it looks like the stock will end at about 45 according to this formula. Of course, it could be wrong. And if Starbucks has a great year, it looks like it'll end at about 65 and a half, but we'll just go with 65 for a whole number, and then we'll see. And then we'll do a net upside or negative net upside, which in this case is negative 16.5%. However, Starbucks does pay a dividend. So we come over here and we see it's about 1 1/3. So if you add that in, you would expect about 15.3% loss. So you would do, let me just type it out, 0.1533. That's times -1. Well then, there we go. You're expecting that kind of gain. So this means that if you put in $100 at the end of the year, you'll get back $85 approximately. This is, of course, assuming that the stock performs the way that you see on the screen. If all of this information comes true, the information on the screen right now, then the stock will most likely be approximately in that range. Give or take, like 0.1%. Give or take 0.1% about. So keep that in mind, and remember that this is real money that you're dealing with, unless you're playing a game, which there are actually games out there. I remember in high school I played one, but keep in mind that if you are investing real money, be careful. If you lose all your money, I'm not responsible for it. So if you follow my trick and you lose all your money, I am not taking any responsibility. Anyways, if you have any questions, feel free to leave it in the comments below. I've been doing this for quite a while, so I know quite a bit about this. If there's anything else that you don't understand, there's a billion videos out there, but if you need me to, I can make another video. But there's probably a billion videos out there that do a better explanation than I do. So until next time, see you guys then.